To build a robust portfolio, you need to include many different styles inside that portfolio. So mean reversion strategies, breakout strategies, trend following strategies, seasonal strategy, and so on and so forth. And one of the great diversifier to those styles is gap strategy. So a gap strategy depends on the gap that happens in the market for whatever reason. In this video, I will teach you how to build gap strategies using a standardized methodology. So first of all, we need to divide where the gap will happen. So imagine this is the previous bar, and today the open happens below the low of yesterday. So this is a down gap below the low. This is zone 1. Zone 2 happens when the open happens below the previous close and above the low. So this is zone 2. Now remember, this close could be anywhere. And anytime the open above the close and below the previous high, that's zone 3. We are up below the previous high, but above the close. And of course, the last zone is we are up. So that means the open happens above the previous high. So those are the 4 zones that we will divide our gaps in. Now, why do we do this? So again, this is to standardize the methodology that you will build gap strategies on. Now, of course, you can do this in many ways and you can complicate things, but really this is the most important, the zone. And then the next important thing is how big is the gap? And we can measure this in points, but of course, then it's going to be hard to standardize over multiple markets. And even on the same market, when it's $100, it's different than when the market trading at $1,000. So we need to standardize this with average true range. So we need to see where the gap happened in which zone and how far in terms of a percentage of the average true range. Now, first you will encounter a problem that you need to solve. So for example, this is the EC futures, which is the Euro US dollar currency. And because this instrument trades 24 hours a day, it will be extremely hard to find a gap above the previous high or below the previous low. And we can see this here easily. You can see the open always happen within the previous bar because this instrument trades 24 hours. Now, while the instrument trades 24 hours a day, it's not actively traded 24 hours a day. And you can find this with volume. So here is the same instrument now on 15 minutes intraday, and the volume is in orange. And you can see the volume spikes a certain period and die in other periods. And actually you can build a pattern. We can see that it's almost always between 8 and 2 p.m. we have a lot of volume. And you can find out the most active periods. And for example, here we can see there is another session that is active, which is usually the European session, and this is the American session. And this is the Asian session. Now, this tool comes as part of my algo trading masterclass. This tool finds seasonality among many things, and it also gives you a heat map of volume. So you can see this is the average volume for the euro currency. And it shows that there is a period of high activity. So for example, this is from 9 a.m. till 1 p.m. on all days, Monday all the way to Friday. We can see this is highly active compared, let's say, to 7 p.m. Look at this. So at 7 p.m. on average, we trade 252 contracts, while at 11 p.m. on average, we trade 4,260 contracts. So clearly, this is highly more active trading than this period, also this period. So now we can build a bar at this hot period. Okay, so what you see now is this is the normal 24 hours of euro currency. And this is the bar I built from 8:30 a.m. till 1:15 p.m. Eastern Standard Time. So this comes to 285 minutes. So this is the daily bar, consists of only those 285 minutes. And now we can see clearly there are multiple gaps throughout the data. So you can see this bar has a huge gap, and this bar has a huge gap, and you can see this one is actually a doji here, and so on and so forth. So you can apply this trick to any market that trades 24 hours a day. It's impossible that it will be the same activity 24 hours a day. So you can easily split like Asian session, European session, American session, even the American session. For some futures, there is not a lot of activity above, let's say, 1 p.m. So here I have the EMD, which is the S&P 400 mid cap, and this is the daily time frame, and this is a 5-minute time frame. So here is how we will find a gap strategy on any instrument. By the way, you can download the code for the strategy in the Discord server. So this is what we are looking for. The gap type, this is the zone. So it's either 1, 2, 3, or 4. So we go from 0 to 4 in step 1. Now 0 means there is no gap. I mean, there is a gap, but we don't care. We will trade anyway. I usually do this in order to find the original strategy before the filter. And then the gap amount, this is the amount in ATR that the gap will have. So this is important to have this strategy standard on every instrument you want to look at. Because if the price is $100 and the gap is $2, that means it's 2%. But if the price is $2,000 and the gap's $2, that means the price is 0.01 of 1%. So really it's meaningless then. So we need to do it with average true range, because then we can standardize even on the same symbol when the price changes, and of course on any instrument. So here I'm doing it in 3 zones. So it's either 0, of course, that means we don't use it, and then 0.5, 1, and 1.5 average true range. And then the exit, so we're either exiting same day, that's 0, or we're exiting in 1, 2, 3, or 4 days. And finally, long or short. So long is 1 and 2 is short. So all this will give us 200 combinations on every market. So this is the result. So let's filter those trades. If we do a minimum of 50 trades and a minimum of $50. So we have about 22 profitable trades, and let's see if we find something in common. So we have about 10 strategies that are above $150. I mean, we can work with these strategies. So 10 strategies with more $150 on average. So you can see this is 503 because there is no gap here. We are only trading with the gap amount, which is the ATR. So with the gap at 0, that means it's a breakout strategy now. But still, we have this one is 182 trades, and that's gap number 4. So that means we are opening here and we are going long. So that's gap 4. And the gap has to be 1 ATR, and we are exiting same day, and 1 is long. The next one, that's the gap below the low, and it's also 1 ATR, and again we are exiting same day, and again we are going long. So that means if we open here or open here and the gap is more than 1 ATR, then we can go long, exit the same day. We will make around $200 on average. And that's more than enough to cover slippage and commission. So this is how the strategy looks like. It's 236, return on maximum drawdown, profit factor 138. And the way to work with any strategy, like I taught you many times on this channel, is by using a filter. And if you watch my last video, I show you how to use the market regime as a filter, because it uses direction or volatility or both. In this video, I'll show you something simpler, which is only direction, and that is the ADX indicator. So now I added the ADX indicator, and this is the ADX look back and the threshold. So we're only going to take the trade if there is a trend in the market. So the ADX look back of 10 above 30. So I'll optimize the look back from 5 to 20, step 5, and the threshold from 10 to 40, step 5. So that will bring the combinations now to 5,600. Okay, so we have our result, and let's filter again. And look at this. Now we enhance our strategy a lot by adding this filter. So this one has 121 trades, and gap type is 3. That means we're opening above the close, below the high, and then doesn't matter what the gap amount is. But now because of the filter, so look back of 20 and threshold is above 30. we are making much better trades. And now I'm going to combine multiple strategies in a portfolio. Not only that, I'm going to mix the long and short of the same instrument just to show you the correlation of this strategy. So for example, here I have the mid-cap 400, and this is long and this is short, and the S&P 500 long and short, and Dow Jones long and short, Nikkei only long, and then the Nasdaq long and short. And this is the portfolio performance: 331,000, maximum portfolio drawdown is 60, and we have 5.56 return to maximum drawdown. And this is the annual performance. So we make good money. We lose a little bit in 9 and 10 in 2012, and well, look at this. Last 5 years are amazing. But here is the most important part. All of them, long and short, are profitable. And now based on monthly equity, look at this. EMD, this is long. It's 0.03 correlated to the short side. So this is nothing. And then the S&P 500, this is long. It's negatively correlated to the short side. Again, that is amazing. The Dow Jones, this is long, negatively correlated to the short side. And then the Nikkei, which is the Japanese index, is a little bit correlated with the mid-cap 400 and a little bit with the Dow Jones short side, but otherwise it's not for the others. And then the last one is Nasdaq. So this is the long one, and it's 0.18 correlated to the short side. And this is the equity curve for the whole portfolio. The amazing part is the correlation part, because you can trade the same instrument, long and short, with almost zero correlation. And between all the instruments, again, the correlations were so low, and this is on monthly equity. Because really, it's a lot easier to find low correlations on daily returns, but on monthly returns, it's a little bit harder. To learn more, make sure to watch these videos, and I will see you there.